You lost money today, and yesterday, and every day before that.
$36 trillion in debt, $5 trillion printed in 3 years, a currency that loses purchasing power every single day. Last episode, we broke down the money printer's endgame, the 4 options, the historical pattern, Rome, Weimar, Zimbabwe. The conclusion was clear. They always choose inflation. They always choose to print. But we left one question unanswered. If the dollar is broken, what's the alternative? What makes Bitcoin any different from every other currency in human history? The answer is one number, 21 million. Welcome to Exit Velocity. I'm Justin, and this is episode 10, Why 21 Million? Let's start with a question that sounds simple, but isn't. Why is Bitcoin capped at 21 million coins? Satoshi Nakamoto, Bitcoin's creator, addressed this in an email to early developer Mike Hearn. He called it an educated guess. He knew that once the network launched, the number would be locked in. He needed to pick something and get it right the first time. Here's what we think informed that choice. When Bitcoin was created in 2009, the global M1 money supply, that's all the physical cash, coins, and demand deposits in the world, was approximately $21 trillion. If Bitcoin eventually replaced that system, each Bitcoin would be worth roughly $1 million. And at that price, each Satoshi, the smallest unit of Bitcoin, 100 millionth of a coin, would be worth exactly 1 penny. 1 Satoshi equals 1 cent. That's elegant. That's intentional. But here's what most people don't realize. The number 21 million doesn't actually appear anywhere in Bitcoin source code. There's no line of code that says max supply equals 21 million. The cap is an emergent property of 2 design decisions Satoshi made. First, the initial mining reward was 50 Bitcoin per block. Second, that reward cuts in half every 210,000 blocks. Do the math. 50 plus 25 plus 12.5, and so on. That geometric series converges on exactly 21 million. The cap isn't a rule imposed on the system. It's a mathematical inevitability that falls out of the design, and because of rounding in the code, the actual total is 20,999,999.9769 Bitcoin. It never quite reaches 21 million. It's asymptotic, which is kind of beautiful if you think about it. So how does this actually get enforced? Who makes sure nobody cheats? This is where Bitcoin is fundamentally different from every monetary system that came before it. There's a function in Bitcoin source code called GetBlockSubsidy. It takes the current block height, divides by 210,000, and performs a mathematical operation called a bit shift to calculate the reward. After 64 halvings, the reward hits 0. That's it. That's the entire monetary policy of Bitcoin, written in a few lines of code that anyone on Earth can read and verify. But code alone doesn't enforce anything. What enforces it is the network. There are tens of thousands of Bitcoin full nodes running around the world right now. Each one independently validates every single block. If a miner tries to claim more Bitcoin than the protocol allows, even 1 extra Satoshi, every node on the network rejects that block. It doesn't get added to the chain. It doesn't exist. There's no CEO to call, no board of directors to lobby, no emergency meeting where someone decides to make an exception. The rules are the rules, and they're enforced by math, not men. Now, the skeptics question, couldn't they just change the code? Technically, yes. Any developer can fork Bitcoin's open source code and change the supply cap. You could do it this afternoon. The problem is getting anyone to care. For a change to Bitcoin's rules to take effect, it requires what's called a hard fork. Every node operator, every miner, every exchange, every wallet, they all have to voluntarily adopt the new software. If they don't, the change doesn't exist. You've just created your own irrelevant copy of Bitcoin that nobody uses. And here's the game theory that makes this essentially impossible. The people who would need to approve the change, node operators and Bitcoin holders, are the exact same people whose wealth would be destroyed by it. Increasing the supply dilutes every existing coin. You're asking people to vote for their own financial harm. It's a Nash Equilibrium. No rational participant benefits from deviating. We don't even have to theorize about this. We've seen it play out in real life. In 2017, Bitcoin went through its biggest governance crisis ever, the Blocksize War. More than 50 major Bitcoin companies signed the New York Agreement to change Bitcoin's rules. Over 80% of miners signaled support. These weren't small players. This was the majority of the industry, with billions of dollars behind them. They failed. The users said no. Node operators refused to run the new software. The proposal was abandoned. The companies that pushed it were effectively overruled by individuals running nodes on laptops and Raspberry Pis. If 80% of miners and 50 major corporations couldn't change a relatively minor technical parameter, what are the chances anyone changes the fundamental monetary policy? The 21 million cap isn't just code. It's a social contract enforced by economic self-interest. It's the hardest money ever created. Let's put this in perspective with some numbers. Bitcoin's stock-to-flow ratio, that's existing supply divided by annual new production, is currently around 120. Gold's is around 65. That means Bitcoin is roughly twice as scarce as gold by this measure. And every 4 years when the halving occurs, that ratio doubles again. The most recent halving was April 2024. The block reward dropped from 625 to 3.125 Bitcoin. The next halving is estimated around April 2028. Right now, approximately 19.85 million Bitcoin have been mined. That leaves about 1.15 million left to be created, less than 6% of the total supply. And here's the kicker. The last Bitcoin won't be mined until approximately the year 2140. It took 17 years to mine the first 19.85 million. The final 1.15 million will take over a century. But the real number is even more extreme. Blockchain analysis estimates that 3 to 4 million Bitcoin are permanently lost. Forgotten passwords, damaged hard drives, early miners who didn't realize what they had. Satoshi's own coins, roughly 1.1 million Bitcoin mined in the earliest days, untouched since 2009. That means the effective circulating supply isn't 21 million. It's closer to 16 or 17 million for 8 billion people on Earth. Compare that to the dollar. In 2020, the Federal Reserve created $5 trillion in new money. They didn't need anyone's permission. They didn't need consensus. They didn't need a hard fork. One institution made a decision, and every dollar in your pocket got weaker. Bitcoin can't do that. Not because someone promised it wouldn't, because it mathematically can't. This is the part that trips people up. We've been trained our entire lives to trust institutions, trust the Fed, trust the Treasury, trust the experts. And when someone says trust the math instead, it feels alien. But think about what you're actually trusting when you hold dollars. You're trusting that politicians won't spend more than the country earns? They always do. You're trusting that the Federal Reserve won't print money to cover the gap? They always do. You're trusting that inflation will stay at 2%? It never does. Not for long. When you hold Bitcoin, you're trusting that 2 plus 2 equals 4. You're trusting that a geometric series with a halving interval converges on a fixed number. You're trusting math that anyone can verify, running on a network that no one controls. 21 million. Not because someone promised, because the math doesn't allow anything else. Next episode, we're getting practical. You understand why Bitcoin matters, but how do you actually get it? How do you store it safely? What's a wallet? What's a seed phrase? And what mistakes do beginners make that cost them everything? That's episode 11. Bitcoin for beginners. Until then, think in Bitcoin.